hello everyone, and an extremely warm welcome. This is a very, very exciting day for us at Fussell Associates and our partnership, our strategic partners with Analytics Consulting. I thought I'd start by just obviously saying a warm welcome to those that are going to be watching the recording rather than obviously with business constraints. A warm welcome to you too. We will be sending it to everybody, and hopefully you guys enjoy it as much as we will, and sharing my excitement because I can't really contain myself at the moment. It's a bit of a thing. I thought I'd just quickly start with a little bit of an intro with a history to why we've done what we've done. About 12, 13 years ago, James and I, Fussell Associates, tried to optimize portfolios for our clients. We teamed up with Investec, at that stage, Investec's quants team. And then we, under the very strict guidance of John Eckstein, who's the MD of Analytics, we had to wait until we had critical mass, a decent amount of size, and then we launched model portfolios about 11 years ago, going on 12, been very successful for our clients. November 2019, we hit critical mass again. We were able to launch the Worldwide Flexible Fund. It's a unit trust based in SA, which has been a great success for our clients and ourselves. And again, 10 years in the making. John, made it very clear to us we had to wait for critical mass again to launch anything offshore. We've now reached that scale, and we can now any offshore or international exposure that we have within our portfolios locally and offshore will be done via this team at the moment. It's extremely exciting because it's a separate team, and Bernard van Wyk, you're basically in the screenshot there. He's basically the head of setting it up. It's a completely specialist team. They specialize only in the offshore side, so the local managers that we're using through Analytics are different to the offshore. So it's an incredibly robust team. It's been around for a very long time. We have utmost faith in them and their ability. So a huge welcome to you, Bernard, and your team. Again, the main reason we're doing this is for opportunity set. So again, due to our size, we need to maximize the opportunities for our clients. In South Africa, unfortunately, to get decent offshore exposure costs a lot of money, and the opportunities that are actually there for good managers are very thin. We don't have exposure to what there is overseas. So we are so excited that any offshore exposure we can have now, we believe that the opportunity set is about 100-fold to what we've got here. We believe that through the size of the organization now and teaming up with Analytics, we can make access to funds and to ETFs and to different skill sets that we have no access to in South Africa. And this is a huge differentiator between us and a lot of the opposition, or the other fund managers, or broker funds, as the FSCA like to call us. We're very, very proud of this moment. We believe it's going to enhance our portfolios massively. There will in time be a reduction in the cost offshore. We're not rushing in and changing the whole thing 100% in one shot. We're doing it as a very staggered approach. We're doing it very prudently. So initially there'll be a very small saving in the cost offshore, but within the next year, with the optimization that we have planned and the phase 2, phase 3, and phase 4 rollouts with Bernard and his team, we are very excited that we could shave a large portion of the costs off, and that's important. So it's not only having a bigger opportunity set, but it's doing it at a more cost-effective level, and at the same time adding to our entire model of diversification. We've said it with our model portfolios. We've said it with our unit trust. It's if we don't diversify properly, then we haven't actually met the needs of our clients. Through this offshore exposure and this offshore offering, we believe we've enhanced the diversification tenfold. We are not reliant on SA fund managers dictating to us on what we do and how we do it and what sectors we chase. Bernard and his team have full control of how much equities do we have, how much property, how much growth versus value. We are in total control of that, and the beauty with that is that we can enhance our diversification. So as I said, I cannot contain the excitement. I can't tell a lie. We had an investment committee meeting yesterday for our third quarter, where we saw this for the first time rolling into our portfolios, our local portfolios, the effect it's having, and seriously, it is a wonderful time for us, and we just hope hope that we can continue to deliver what we've promised. We believe we can. We believe we're going to enhance the portfolios a great deal. So I'm not going to steal Bernard's thunder. He's going to take you through the funds. He's going to take you through what we've done and why, and how we've set it up. And I think just give you a snapshot of where we're heading to. And it's always our client's best interest at heart. So with that, I'm going to turn my monitor off, and you're not here to listen to me or to look at my ugly mug. So the monitor will go off, the audio will go off, and I'll hand over to Bernard, and a huge Bernard to you and your team.
Thanks, Andrew. Thank you very much for the introduction. So today's discussion is all about how we look at the offshore markets and how we access that through the fund that we've established. And I want to start off by addressing probably three of the major themes currently in the market before I get to the fund structure and the fund positioning. And if we can kick off, the first one that's very topical currently when you open the newspapers or you're reading information about the markets is about inflation, especially in the US. And the main reason for this concern or angst about inflation, because inflation typically results in high interest rates, and high interest rates has impact on financial markets. And what kicked off a lot of this was the inflation numbers that came out recently. I'm showing you here the US inflation numbers, excluding food and energy, so as we refer to core inflation. And in May, the US came out with an inflation number of close to 4%. And if you look at the graph going back till the late 50s, you can see that number there, the 12-month number. We haven't seen such a big number since basically late 1980s. So the market was a bit concerned. There was a lot of talk about whether we are moving towards a higher inflation environment. And the US Fed, or the US Reserve Bank, came out and says, well, it's a lot about COVID and the policies implemented to stimulate the economy that's causing the inflation, and it's not structural. So markets should not be concerned. And if you look at the longer trend in inflation in the US, that's the blue line there. It just measures inflation over a 5-year period. You can see that since around about early 2000s, the US hasn't had inflation in excess of 2%. So this concern about inflation and what the Reserve Bank is telling the markets is causing a bit of debate around investors. And when we looked at in more detail at the numbers that came out, it intuitively makes sense, actually, that if you unpack the inflation pressure points, you'll see that a large portion of the big increase or jump in inflation came from two components of the inflation basket. One being vehicles, so used cars and trucks. It increased at the end of May, almost 30% year on year. And the reason for that is new cars were not readily available because of a shortage of microchips that's sitting in the vehicles. And so for us, that was a supply constraint caused by COVID. The other big component of the US inflation basket is housing. So shelter is the definition they use, but it's effectively rental and house prices. And you can see it makes up a third of the inflation basket. So a 2.2% increase in that has a big contribution to the number. With interest rates at extremely low levels, especially the mortgage rates in the US, we've seen house prices increase. And that was an attempt by the US Fed to stimulate the economy. So for us, looking at inflation numbers, we tend to agree with the US Fed that this is all related to the COVID pandemic and the stimulus around sustaining the economy. And this is not sustainable inflation pressures, and this is probably just a base effect. But that's not the only point of the argument. Where we are seeing potential inflation pressure building is in US wages. Now, the US Fed made it very clear that they are not too concerned about inflation, but what they want to see in the US economy is the employment numbers going back to pre-COVID levels. And the way they look at employment, they look at the portion of the population that's employed as a percentage of the working age population group. So that is people aged between 16 and 64 in the US. And prior to COVID, it was roughly around about 62% of the US population was effectively employed. And currently it's sitting around about 58%. And the US Fed would like to see that number back, what they refer to as full employment. And to get back to full employment, you probably need to get people back into the job market. And that probably could spill over into providing higher wages to incentivize people to come back into the job market. So as an investment committee with our partners, one thing that we are focusing on is wage inflation. And what I'm showing you here in the blue line is just year-on-year percentage changes in wages in the US versus normal inflation numbers is the red line. It's the difference between those lines that tells us, but how much is wages growing faster than inflation? Because that potentially then results in pressure points in the market. And when we look at this, we can see that wages has been rising faster than inflation. So at this point, we want to focus on companies that can potentially tolerate higher wages. And when we look at our fund structure, our preference for quality investment managers, so managers that focuses on companies with high profit margins, is important now, because the better your profit margin, the more you can buffer your earnings against higher wages. So just to conclude on the inflation debate out there, we do think that we need to watch wages. That is probably the big component that will result in whether consumer inflation increases or decreases. Because remember, if the working population in the US is getting wage increases in excess of inflation, it means there's more money in their pocket. And the question then comes back to how do they spend that? Do they spend it on consumer goods, or do they use it to deleverage their own personal balance sheet? And a lot of commentators are saying, well, since the global financial credit crisis, US households has already deleveraged quite a lot. And there is an expectation that higher wages will spill over into consumer spending. And consumer spending is a very big component of the US economy. So wage inflation doesn't necessarily have to mean a negative impact on the economy. But as I mentioned, one need to take that into consideration in how we construct our portfolios. It's our belief that we're going to see long end of the yield curve increase first. So long-term interest rates will probably pick up first as the US Federal Reserve starts pulling liquidity out of the market because the economy is on stronger footing. After that, we will probably only see short-term rates increase. So at this point, we think looking at the interest rate cycle, it's still favorable for growth assets. And that brings me probably to the next point that's also getting a lot of attention, is whether markets are expensive. Now, if you just look at prices per se, and here I'm showing you the price of the US equity market as represented by the S&P 500, so the top 500 companies in the US. And you can see the prices actually how it accelerated after the pandemic. On the next graph, you can also see that this is just a composite of house price in the US. And again, you can see very strong increases in this. And a lot of this was on the back of very low interest rates. So it's been an environment that was favorable for these assets. And the question is whether it's expensive. And what I would like to share this is just take a step back quickly. And this is very good information that we get from JP Morgan. And I always get, when markets and newspapers starts talking about the equity market has reached a new high, in essence, markets will always reach a new high because it grows in excess of inflation over the long term. So we have to take a longer term view on markets. And this goes back to basically the start of the 1900s. And it's showing you the long-term movements or in the cycle of markets. And what is important is that markets typically moves in long up cycles, and then it moves a bit sideways, and then another long up
Net vir
cycle.
my omdraai dat hy so kan wees, want ek kan Fussell daar sien.
So where we are currently, we think we are actually still in a long-term uptrend in markets. And these cycles typically start and end with recessions. So coming back to how we look at our portfolios, the one thing that we are monitoring is whether there is a potential recession on the horizon. And an input into that decision is looking at global leading indicators. So these indicators currently is still pointing upwards. So it's showing us the economies are still in an expansionary phase, and interest rates is still accommodative. So we don't think we are in a point where we were going to see a substantial market correction based on where we are in the cycle. But having said that, coming back to the question of whether markets are expensive, and the graph what I'm showing you here is showing the price investors are paying for next year's earnings on the S&P. So you can go back to the tech boom in the late 90s. You can see investors were paying 24 times more for earnings generated by companies. So if you just look at the price to earning, you can see where it's sitting today, essentially paying 21 times for earnings, which is expensive. If you look at a couple of other valuation ratios, I mean, the CAPE ratio is effectively the same as the price to earnings ratio, but your earnings you just adjust by inflation. And the way you can look at this table is just look at the numbers compared to the long-term average and whether it's below or above that number. So you can see the price to earnings ratio is 1.46 times above its long-term average, implying it's expensive. And if you go through the table, you can see across the various valuation ratios, the S&P at the top-down level is looking expensive. So what is important, though, and I'm showing you here is just the top 10 companies on the US market. And what you'll notice is it's dominated by effectively technology companies. So the top 10 makes up 29%, almost 30% of the market, which is highly concentrated. I mean, we haven't seen this high level of concentration in the US for quite a while. And these companies are the companies that actually, on the back of COVID, did exceptionally well because their business models weren't impacted by lockdowns. So a lot of their share prices accelerated way above where their earnings was actually being released and resulted to investors. So if you look at this, yes, the market per se, if you look at the broad market, is looking expensive, but I just want to focus your attention on within this, Berkshire Hathaway as a financial conglomerate is trading at a price to book ratio of 1.4. If you look at JP Morgan, another financial company, it's 1.8. So the market is expensive because of technology companies that's actually dominating the US market. We still believe that there are pockets of opportunities available even in the US market. So in this environment, we believe one should be more selective in your exposure than just being purely passive. But there are still opportunities out there. If I can just show you then, coming back to this conversation about concentration in the US market, what I'm showing you here is you can see the top 10 companies, as I mentioned, is sitting on 29% of the S&P. We haven't seen that level of concentration The last time we were there was probably at the end of that technology boom. And looking then just at valuation levels, so you can see the top 10 companies are is contributing a lot to the expensiveness of the market. But interesting enough, when you compare that top 10 companies to their own history, so this is the green line, it's not as expensive as we've seen them at the peak of the technology boom. The rest of the market is also then trailing somewhere towards the top end. So for us, looking at all of these numbers, it's telling us we need to be more selective. We can't just go passively into the broad market. We need to find that opportunity set. So when I'm going to talk to our portfolio, you will see a large portion of our portfolio currently is being actively managed. And then talking about the opportunity set there, this is just showing you the discount of the markets to the US, so basically outside of the US. So if you can look at this graph, again, looking at the price investors are prepared to pay for earnings, but this is just showing you it's how much cheaper the markets are outside of the US. So we think outside of the US, there's ample opportunity still for investors. And especially as Europe is catching up in terms of the rollout of their vaccinations. I mean, they were slightly behind the US and the UK. Europe is catching up. So there is still a lot of potential for earnings growth to come through. And this is just showing you the difference in dividend yields, which is also just another valuation ratio. So we think in certain sectors, there's opportunities, and as well as in certain regions. And that is what we're currently expressing in our portfolio. So just to conclude very briefly on this conversation around valuations and whether markets are expensive, I want to show you first is looking at global valuations. And again, this is a price to earnings valuation. So the price you pay for earnings. And what you can focus on is the purple bar in the middle and then the blue diamond. So effectively, what is the long-term average and where is it currently trading? So when you look at this, you can see the US is trading way above its long-term average, but it's not above the range that we've witnessed over the last 25 years. You can see emerging markets is slightly above, so not as expensive. China is also slightly above, Europe is only slightly above, and Japan is actually below. So coming back to the point is being selective and where you allocate your capital in your portfolio is important. And then also just looking at where the market is anticipating earnings to come from. So in 2020, obviously with COVID, a lot of markets struggled to deliver strong growth because of lockdowns. But the anticipated earnings for 2021, you can see, for example, in emerging markets, anticipating a recovery of up to 50% in earnings. In Europe, we're seeing now 44% anticipated earnings growth. The US already has reported very strong numbers. So we need to bring into context is the valuation versus the growth outlook. So we still believe there is ample opportunity. And then just to show you what the anticipated earnings, or let's call it economic growth is, this is just forecast from the World Bank, looking at the next 3 years. So advanced economies, we're looking at economic growth net of inflation of 12% cumulative over the next 3 years. So you can see the US is definitely delivering very strong economic growth. Europe slightly less, but Europe is much cheaper in terms of an investment opportunity set. So you need to weigh those two together to give an indication of where you want to allocate your capital. What's interesting though for us, and we get a lot of questions on this, is, but what about South Africa? South Africa is very cheap. The concern we have though is the growth outlook. So just because an investment is attractively priced on its own doesn't warrant to make an investment, because you still need to see the growth that comes through in that investment. And you can see there South Africa currently, the outlook, and this is from the World Bank for the next 3 years, is 7.3% growth. So we think there is more attractive opportunities for investors, and that's why we have the fund available for investors. talking about South Africa, a couple of takeaways, and maybe our discussion today is more about the offshore fund, but I want to address this because I think it's important because we are all South African investors. It's been a volatile couple of weeks, but it's not all bad news. What we've seen, we tend to forget about some very positive developments, and especially the developments that's been playing out is very positive news for the fiscus, or basically the way our government is running their finances. So having a 51 equity partner in SA Airways is definitely, hopefully, going to help us. So any future potential bailouts is probably no longer required because we've got a strong equity partner in there. The ability now from private companies to generate electricity up to 100 megawatt is a huge win for the private sector. So we anticipate to see a lot of the big mining companies, for example, as to step in and start generating electricity, and that will take off a lot of pressure on the grid. And then another big win, which is potentially totally just out of our control, is the fact that commodity prices has been very strong on the back of the global economic recovery. And that strong commodity prices has resulted in mining companies in South Africa paying more and more corporate taxes. So by the information and news that we've seen, it looks like we will be generating more tax revenue than what was budgeted for. And that is positive news for us. There are still, however, some potential concerns that is probably something that foreign investors are looking at when they look at our market. The one is the Land Appropriation Bill, which is still uncertainty about how that will play out. And then a lot of talk about providing a universal income grant. Again, we don't have the finances to provide that. The documents that we've seen is indicating a wealth tax, so taxpayers to fit the bill, and it looks like they're talking up to 3% almost required to provide a universal income grant. And then the other one again is the national health insurance. So again, it's a massive expense for the government if they want to roll this out, and the question remains, how do you finance that? So unless these issues are not addressed or we have clarity on them, it's going to be difficult for foreign investors to get really positive on our market. Then obviously the recent ugly news that's played out in South Africa, and we tend to forget that just a couple of months ago we've witnessed in probably the most developed market also these riots and protests. So we need always to be aware and place everything into context. So from an investment perspective today, and I want to focus on the investment side of what's playing out. I just want to bring back the message to our investors that as a South African investor, when you invest on the Johannesburg Stock Exchange, you potentially actually don't have a lot of economic exposure to the South African economy. So if I can explain it by an example, if you look at Anglo American, it's almost 10% of the JSE, so it's a large company on our market. But 100% of its revenue is effectively generated outside of South Africa. So yes, it's got mines and operations here, but the revenue, because it's selling into the offshore market, it's commodities. So effectively, it's the global growth that drives this company's earnings. Compare that now to FirstRand. You'll see obviously FirstRand's got a lot more exposure because it's a domestic bank. So if you go through the whole list, I think this is the top 20 companies. It makes up 75% of our market by market cap. What is interesting is that of those 75% of the JSE, only 14% of their revenue comes from our economy. So despite the weak growth outlook, we need to be cognizant of what the impact will be on our portfolios. So a lot of earnings is coming outside of South Africa. And in fact, more is coming from China currently than from our own economy. So the Chinese economy, the world economy, the demand for commodities is probably much more important for us when making investment decisions than just necessarily what's playing out in the local market. Now, this is just talking to the equity market. Obviously, there's also the fixed income market where you invest in debt instruments. And one way to assess how foreign investors is looking at a market is to compare it to a suitable peer. And here we're looking at Brazil. And what I'm showing you in the graph is the cost of the government to fund its debt over 10 years in dollars. So we try to make it like for like. And you can see there, the latest number is 4.13. So what it implies is investors require 4.13% in dollars to make an investment to the government for 10 years. To get investors to make that commitment to Brazil, they require 3.82%. And it's the difference between these two that we can say is the additional risk investors need to be rewarded for to compensate them. So what's interesting is, I hope you can see that is in the background, there's a green bar or green graph running. And what we look at this is just the difference over time. And despite the events, we haven't really seen a big move in the relative interest rate differential between these two markets. So the foreigners didn't really react to the events that played out, because otherwise this red line would have been much, much higher. And we witnessed the same in the currency. So again, we're comparing it to Brazil because Brazil's got essentially the same credit rating as South Africa. And you can see the movement over the last couple of weeks is really on par with broader emerging market movement. So a lot of foreign investors didn't really overreact to the events. But I think what's important for us as South Africans is that we require foreign direct investment into our country to get economic growth going. And for me, on this topic on South Africa, this is probably the one graph that's worrying us the most, is when we look at GDP per capita. So effectively, economic growth per person in South Africa. So you can see the impact of COVID across various industries. So you can see lower income, middle income, and high income countries. So in South Africa as well. So everybody basically had a decline in GDP. But for me, it's this number, the fact that over the last 12 to 15 years, our real GDP growth has actually been sidelined. So there wasn't any strong growth in our market. And as a result of that, we're not generating enough jobs to address our unemployment numbers. So we know that our wage bill is a concern, and so far it looks like we've been managing trying to get wage increases this year much, much lower than in the past. But you can see on this graph, South Africa wage bill as percentage of GDP is very high, and as a percentage of expenditures also high. So we're sitting very much in line with Brazil, and we're paying a lot of our GDP, we're paying back just in interest payments. So we need foreign direct investment to generate growth in our market. And this is, if you look at this GDP number, this is probably why we're not getting super excited about local companies. As I say, because valuations are looking attractive, but you cannot grow your company if the economy is not growing. And this then is what you're probably all well aware of, is our unemployment number. So our unemployment is something that's probably, I think, caused a lot of the unrest, is unemployment. And the only way really to get this number down is for our economy to grow in excess of, well, I think the number a couple of years back was 5% GDP. And for that, we need foreign investors, and we need them to be confident on our country. Right. So that's just the background in terms of our thinking on markets. I want to now just turn our attention to the fund that we've launched. So very briefly, the fund is focused on long-term capital growth. And we invest in various asset classes depending on where we are in the business cycle. And typically, to generate growth, it will have a bias towards equities. And if we go through the portfolio allocation, you'll see currently we have a strong bias to equities. As I mentioned earlier, the leading indicators is not showing us that it's time to start looking at defensive assets yet. The economy is still expanding globally, and we're still finding opportunities for our investors. If we look at the structure of the fund, we manage it essentially in three components. The first one is our broad market passive allocation. We use funds and instruments from probably the top 3 asset managers in the world. State Street, it's got a very long history. It manages just over more than $3 trillion. Vanguard, it's probably one of the biggest asset managers out there. It was the first company to launch an index tracking fund way back in the 70s. They're managing $7 trillion. And then BlackRock, it's got $9 trillion. So these are the 3 giants in terms of passive investing. And we use their instruments to provide us with broad exposure to markets where we find attractive. I suspect when our meetings with our partners in Mauritius, a lot of discussions will be on our exposure to US and how we can mitigate some of that opportunities that we've seen outside of the US. But well-established managers, we use very cost-effective solutions. The next component then is a quality bias in the portfolio, as I mentioned earlier. We think quality bias results in better risk-adjusted returns, and I'll demonstrate later on exactly why we believe an quality bias is suitable for long-term investors. And here we use, again, an index portfolio managed by BlackRock. So it gives us very cost-effective exposure to an investment style that we think will work well where we are in the cycle of the market. And then the last one is our active managers, and you'll see it's almost 50%. So as I mentioned earlier, we do believe where we are currently in the market, we want to be more active. You want to be more selective. There are opportunities out there. And these are the lineup of fund managers that we're using. You'll see we're using a fund from Fund Smith. That's essentially Terry Smith. I see they're referring to as the English Warren Buffett. He's just much younger. But Terry Smith manages a portfolio that we utilize. And then there's also the Smithson Investment Trust. It's the same investment house. It's just this portfolio focuses on smaller cap companies, whereas Fundsmith is more global. But both of them follow investment philosophy where they focus on quality. And what we mean by quality is essentially looking at profit margins, looking at balance sheets, so balance sheets that doesn't carry a lot of debt. Then 921, you're probably familiar with. It's the Global Franchise Fund. We've been using it for quite a long time in our portfolios that you're familiar with. Again, the franchise fund's got a quality bias. And the reason how they employ, they look at, again, the return on capital generated by companies. They're looking for companies with strong franchise models. Lindsell Train, we use, again, to give us exposure to smaller cap companies where we are seeing attractive valuations. And again, these managers also focuses on good, well-run businesses. It's a smaller manager, but they've done very well for investors. We've made an allocation to Berkshire Hathaway. Now, again, this is to express our view that we think financials are attractively priced, as I showed you earlier. So it's expressing our view on financials. And we know that the way this company is run by Warren Buffett and Charlie Munger is, again, focusing on great businesses. So where we are in the market cycle, coming back to the point, you want to have good quality businesses now. And then the third manager is a US manager, Sands Capital. They focus more in the growth side of the market, so looking for companies with strong growth prospects, but again applying a quality focus on that. So looking for companies that they believe will generate sustainable, high quality growth, and that's the current lineup of the managers. And I want to come back to the point is, why do I hammer on this quality bias of our portfolios currently? So if I can quickly explain, when we talk about quality as an investment style, let's just address quickly, when you look at companies, how traditionally asset managers will assess and companies and how they typically might select companies to invest in. So these are the top 10 US companies, and I'm showing you a price to book ratio. So the book value of a company is effectively, if you take all the assets and you subtract the liabilities, you're left with the book value, and that's the price the market is paying for that book value. So you can see Apple, you're paying 35 times. For JP Morgan, you're paying 1.8 times. Price return is just the movement in the share price over the last 52 weeks. And the gross profit margin is essentially just the margin that the business is generating. So there's three characteristics of companies. And if you are a value manager, traditionally you will focus on companies that you think are attractively priced. So this is just a very simplistic example of understanding the various investment styles. So a value manager will probably look at the top 10 companies, and he will conclude that Berkshire Hathaway at a 1.4 times price to book ratio is very cheap. JP Morgan is 1.8 and Johnson & Johnson is 6.9. Those are the companies on the valuation ratios that is attractively priced for a value process. Apple at 35 times, Microsoft at 16 times will be deemed expensive. Again, guys, this is very simplistic, but I want to explain essentially how these investment styles assess businesses. If you are what we call a momentum investment style, traditionally, momentum implies that you are looking at share prices that's delivered very good price, positive price momentum, with the belief that as these companies' prices are increasing, more investors will come into the market to invest in them. So there's positive momentum in the price. So a momentum style will focus on the middle column. It will see Google generated 75% share price appreciation over the last 52 weeks. That will be one of the top three in this component. Tesla's up 113 and NVIDIA Corporation 85. So if you are looking at momentum strategies, you typically find that in strong rising markets, investors keep buying more of the shares that's gone up. But in our portfolios, we do have a bias currently for quality. And as I mentioned, there's a couple of factors normally that you will look at for quality. I'm just showing one, which is profit margin. But in essence, you will assess the quality of a business of how sustainable and its profit margins are compared to their peers. You also probably want to look at the strength of the balance sheet. So typically what you will find is that they don't carry a lot of debt. And just on this point, I mean, I've mentioned earlier wage inflation. I've mentioned that we potentially going to see long-term rates pick up first. Now, this is why we currently believe that quality potentially will benefit our investors. Because if you are a strong business with a strong profit margin, you could potentially tolerate higher wages. If you've got strong brands, you can easily pass that on to the end consumer. So, for example, consumers of the Apple iPhone might be more willing to pay more for their phone than the users of a Samsung or a Huawei iPhones, cell phones. So brand is potentially becoming a bit more important in an inflationary environment. And also, if interest rates pick up, if you don't have any debt on your balance sheet, you don't have any interest expense to pay. So we think that if you look at companies, we should be careful of looking at businesses with very large portions of debt on their balance sheet. So that's why we currently have a very strong bias to managers that incorporate these views in their portfolio construction, security selection. So let me just quickly show you a bit of background on quality as an investment style. As you're probably aware, equity markets doesn't move up in a straight line. I wish it did. It would make my life a lot easier. But we do get these periods where markets correct. So I'm just showing you here over the last couple of years, you can see that the equity bear market in the early 2000s, when the markets moved from the peak to a bottom and declined by 46%. The global financial credit crisis, you can see the market declined by 53%. And the recent COVID last year, you can see markets declined by 20%. Over the long term, though, the trend is upwards, but the journey is a bit of a roller coaster. So when we look at these different investment styles, we went back in history and we've got data going back to 1982. And we measure the performance of markets over a 12-month period. And then what we ask ourselves is, but when did global equities return less than 10%? How did these different investment styles behave? And we're using data from MECI, which is an index provider. So you can see momentum, so quality and value. So what this is telling us, when equity markets were down more than 10%, on average, global equities were down 21%. Momentum basically very much in line, so down 20%, but quality was down only 15%. Value investing strategies typically declined by close to 18%. So in extreme negative markets, we find that quality protects more. If we then look at periods where markets are, let's call it normal, it's probably somewhere between -10 and +10 over a 12-month period. You can see equities in general 1.9% on average, momentum 5.8%, and then you can see this is where quality really kicks in and generates for excess returns for investors. But when markets are very strong and running very hot, so more than 10%, you can see momentum does very well, and then quality tends to lag. It still outperforms the market. So for us, when we look at all these three components of where equity markets generally moves between, for us, this makes a lot more sense for our investors. So when markets are under pressure, we don't lose as much capital. When markets are normal, we generate excess returns. And when markets are extremely hot and running, the portfolio might slightly lag a bit, but we believe you are more than compensated there for the risk on the downside. And to show this perhaps in a bit more detail, this is almost my last slide. It's just going back in history, looking at when markets corrected. So essentially, when markets declined more than 10% from the peak to a bottom, we looked at the performance of quality as an investment style. Now, this is now before the overlay of active management from the managers we use. This is just looking at the broad style. And you can see here, I think there's 9 periods going back till 1982. In only 2 of them did the investment style lose more let's say decline more than the broad market. So on average, we believe it's more defensive nature of the investment style, but over the full market period of this last 40+ years, it's generated outperformance. So we believe it adds, for our portfolios, it enhances the risk-adjusted returns. So just to conclude on this presentation, I think as an investment committee, we are focusing on wage inflation. That will guide us in terms of where the cycle is moving in terms of interest rates. Yes, US assets are fully priced, but we are still finding attractive opportunities. So we believe it's time to be active, or more selective in where you allocate your portfolio capital. South African assets are cheap, but as I expressed, we remain concerned about the growth, and there is some uncertainty in the market around certain policies that's still unconcluded. Then our offshore portfolio that we've launched for our investors, we have currently a very strong quality investment style bias. And as I demonstrated, we believe that over the full market cycle, it delivers better risk-adjusted returns. And that's our presentation. I'm quite happy if there's questions or comments that you would like to make. I think there is time to take them, Andrew.
Thank you very, very much. As always, very, very enlightening, and it speaks volumes to our investment strategies on the local portfolios as well as offshore. It's a very, very consistent strategy, very long-term view. We're not in it to try and make a quick buck, which is fantastic. And again, I'm filled with even more confidence that this is the right thing to bring into our portfolios. So I don't know if there are any questions, but I'd like to make a comment while people are thinking of one. What I didn't mention at the beginning is there are two different funds of this Worldwide Growth Fund. The one is the Irish-based, it's a US dollar-based fund. It's based out of Ireland, basically because we believe that's the most prudent way of doing it. It is governed by the European regulators. The companies are run out of Mauritius purely because of proximity, and there's obviously Mauritian regulators, and it's FSCA regulated because we've launched an SA feeder fund, which is a rand-denominated fund. It's a direct mimic of the US dollar fund, but it's an access point for South Africans to invest in it locally, obviously with 100% offshore exposure, but it's an SA rand-denominated fund. So the regulation is way stronger than previously, diversification, and as Bernard has alluded to, the opportunities we have there, we're just scratching the surface. We didn't want to make too many massive radical changes on day one because it absolutely isn't broken to start with. But the exciting part of what hopefully you saw from Bernard's presentation is the opportunity set out there is insane. And extremely exciting that we can start tapping into, and we can move between more passives, less passives. We can move between different styles. That's the exciting part for us. So I'm not sure if there are any other questions from anybody.
Yeah, Andrew, I'm happy if the guys want to mail through questions. I'm quite happy to take them via email as well.
Brilliant. You're welcome to so anybody, and firstly, a huge apology to anybody that's now watching this recording. We had a problem with the link going in, so the 7 people that have emailed me through the presentation quite upset. Sincere apologies. I know a lot of people probably tried and gave up, and hopefully they're reading this or watching this presentation, so apologies to them. You're very welcome to email me personally any questions, and I'll personally send them on to Bernard and his team. It's open book, it's new, it's fresh, it's exciting. So there should be a lot of questions. You'll notice from the fund fact sheets, if you are on the pension fund side or invested in our local model portfolios or unit trusts, you'll see that the fund fact sheets will start changing with the allocation to the Worldwide Growth Fund. So if there are any questions around that, please fire them at me. I welcome them at any time.
Thanks, Andrew.
Okay. Again, so I think I don't see any questions, anything coming through. So again, thank you so much. If you did manage to fight through the link problems and log in, I really do appreciate you spending the time. Apologies for wasting the time of the people who couldn't, and a huge thank you for all who's watching the presentation. But to Bernard and you and your team, and the whole analytics team, John and the guys, a massive thank you for the way you've enabled us to enhance our business and enhance the offering to our clients and enhance their investment opportunities and returns. And you are very, very exciting. So again, I thank you very much. And with that, I think we can end it. And again, a massive thank you to everybody.
Farewell. Thank you.